just last week, I was watching something happen in Washington that perfectly illustrates a great concept. It's impacting every single dollar in your portfolio, and it's what happened in the House of Representatives. You see, they passed what I can only describe as a fiscal junk food binge. It's this massive stimulus and spending bill that everyone knows is terrible for America's long-term health. But just as the person knows they shouldn't be eating an entire bag of chips, they do it anyways. And that's where Congress just can't help themselves. And here's the kicker. These politicians are playing fantasy with games and the bond market. And that's really what's going on. The bond market is demanding higher returns, so higher yields, because they know the truth. And the math gets real. And real money is now on the line. I'm Nathan Crombie, and for the past 20 years, I've been really helping successful business owners and retirees navigate these market conditions. And today, I really want to share with you what I call the liquidity diet, and why understanding what all this means to the markets and what they're eating right now could actually be the difference between preserving your wealth and watching it erode. Let me paint a picture for you. And this is really what's happening, especially last week when we were talking about the massive spending bill that passed in Congress and in the House. The House Republicans, despite knowing better, passed the mega bill. And this massive package contains really the bulk of our president's agenda. Now, I'm not here to debate all the politics and talk about all that, but what I am here to do is talk about the ramifications on your money and what this means to you and your family. You see, this is a lot that's going on right now, and what I'm watching unfold actually reminds me of really when you care about someone, especially ones that are making very terrible dietary choices, you really want to be there for them. You want to be that friend to help them through all this, but their doctor has already told them they need to lose weight, to lower their cholesterol, to eat healthier. But instead of making the tough choices, they order the double cheeseburger, they order the fries, they order the shakes, and they really say that they don't really understand, because this is something that right now they're fine, but they don't see how this is going to affect their future. And that's what I feel like when I watch Congress pass the bill, because when you take a look at all of these things, they actually don't really understand that the binging that they're doing on all of this spending is not just numbers anymore. It's not just their government balance sheet. It's a financial equivalent of mainlining pure sugar into our economic bloodstream and just with our bodies. The short-term binge, it might not kill us immediately, but it's the reoccurring binging, the steady diets of bad financial habits that bring about long-term unhealthy consequences. Now, few people think we're at this moment right now that when we're talking about Congress and making all these investment decisions based upon what they're doing. But I'd like to actually talk about something what I call the liquidity soup. And here's where it gets really interesting, that there's a lot of significance here with assets that you really want to protect. And this is really where we talk about diversification as well, because we have stocks and we have bonds and we have all these different elements that go into good diversification. And that's where liquidity, you see, the key ingredient in the soup that we're talking about here, the liquidity soup, there's lots of inputs that go into this pot. And the outputs really is binary. Either we're healthy or we're not healthy. And right now our market soup is being fed several key ingredients. So we have the first ingredient, what I call the systematic buyers. And these are the mechanical price insensitive flows. You see all the coverings of short, really the short coverings that are saying that instead of making money as stocks go down in price, they need to stop and then obviously buy into those stocks. You have corporate buybacks, you have FOMO, and you have a new phrase, FOMO, the fear of missing up from institutional funds. And so think of this as like the base, the broth. And this is where right now is lifting everything. So we have stocks and sometimes bonds that can go up in price just because of this liquidity, these insensitive flows. So this is where actually diversification is not going to help because everything starts to get more correlated. But then you have the federal liquidity happening with all of these, what we call the dealers and these hedges. So this is the seasoning. It doesn't make up the bulk of the soup, but it dramatically affects the taste. Now here is where it gets fascinating though. It's crucial for anyone managing significant wealth. So as you are thinking about this with your own personal wealth, you have what I call the macro trend players. Now these are the big flow pictures, picture flows that are happening with the government and corporate refinancing needs. And like adding the major ingredients, it completely changes the character of our soup. But here's the scary part, that the spending bill that I mentioned, that Congress is trying to pass, is very irresponsible fiscal policy. It's essentially dumping a massive amount of artificial sweetener into the economic soup. And it tastes good for the short term, but our long-term health consequences are severe. Now, I want to break this down because I actually want to tell you what this means. And yes, I've been really trying to equate it to the soup, but the 10-year treasury bond that we have should already be yielding over 5%. Last week we were at 4.5% or a little bit over, and we should be over 5%. Can you imagine what would happen to the bond market and maybe even your portfolio if this reality actually set in? Because here's where it gets personal for you and your family's financial future. You see, the reason why the US market isn't really allowing prices to happen with these yields in the same way, and the reason why we're not seeing 5% yet on the 10-year treasury or seeing the 1-year treasury really start to climb just based upon the University of Michigan's inflation expectations of 7.3% is because it would force the Federal Reserve to admit something that they're desperately not wanting to acknowledge. That it would force them to admit that inflation isn't transitory, that our surging debt issuance is the reason for the season of all this artificial market euphoria. They'd have to change what they're doing entirely, from the Federal Reserve to the Treasury Department. And they'd have to move from all of these short duration issuance to long duration notes and bonds. Now, this is actually something that could be very dangerous, because what's happening right now is that this short duration debt that we've been really issuing for the last number of years is all liquidity providing. So it pumps money into the system and it really lifts everything at once. So all asset classes can be lifted. So that's where we come back to our diversification, and it doesn't matter as much because everything is going up in tandem. Your stocks, your sometimes bonds, the real estate, even cryptocurrency like Bitcoin, it's all going up because of that. But then the longer duration, the debt that we need actually to issue actually sucks money out of the system. It takes the liquidity out and it drains liquidity. So I talk about this because here's what it means for your wealth plan and especially your portfolio. Because right now we're living in an artificially supported market environment. And that's not necessarily a bad thing for the time that we have it, but it's like a patient on life support. They may look stable, they may look like they're doing okay, but then we remove that support system and the reality sets in quickly. You see, the Fed and the Treasury are working overtime right now to avoid that reality check because they know what would happen. It's something that we call the rate of change. And we would have our yields spike. And that would drive equities and bonds and many other assets lower, because it would be a crisis of confidence. Now, this would quickly force what we call a market repricing. So just think of both stocks and bonds going lower in price, and that could trigger an economic contraction, what we're wanting to avoid. But here's the thing about the artificial support system that we're seeing here, that it's not going to last forever. And when things end, the adjustments can actually be brutal, especially for the unprepared. Now, this is why I have two main mantras when it comes to all of this, when studying the market liquidity, to looking at the differences of your wealth plan and what goes into your portfolio. You see, we have the significant investment decisions that are made here. The first one is that there always, right now, seems to be policy intervention that helps us to reverse right at the time that we start to see the bear really starting to come in and markets really starting to go down. You see, our government right now is doing everything possible to keep the party going. Well, the second thing that we're seeing then is that we need now a macro event risk. So something to interrupt these bullish flows. And the event risk is building every day. When Congress passes the fiscally irresponsible policies, when we have our president that is really kind of at the point of still issuing or thinking about tariffs, it all is just like our personal health. It's not the acute symptoms that will worry us. It's the chronic conditions that are building in the background. And with inflation, the real level compounding over time is what actually matters. Because when we talk about what we're seeing in the stock market and what Wall Street is seeing, they care about things that are called the rate of change. But you and I, we feel it at the grocery store, at the gas pumps. But we also feel it with things like our insurance. Because when we take a look at insurance, especially our premiums, have gone up dramatically over the last couple of years. But that's not what Wall Street is looking at. They're saying, yes, inflation has only gone up 2.5% instead of 3%. But we feel the difference, the cumulative difference over time. And with the bond yields, it's less about the level and it's more about how fast they change. And you call that again the rate of change, the volatility of that movement. You see, it's actually a well-known fact out there that boring markets are actually very profitable. It's the exciting ones that when we see everything going up and down at once, that we need this artificial support system, because things are breaking down and it actually can be very dangerous for wealth preservation. The US markets right now have been on an absolute ravenous liquidity binge, and they're fattening themselves with the excess. And just like that obese patient that I mentioned earlier, diet is what they need, but they may not want the pain that comes with the dieting. And yes, a good doctor can tell them all the negative health effects and the reasons to avoid it. But now, just like that patient, the market is really actually saying it's more painful to stop than it is to continue. So here's what that means to you. As a successful business owner and a retiree that needs to understand that the pain of preparation, what we're talking about right now, is far less than the pain of regret. So where does that leave you? If you're a business owner who's built significant wealth, if you're approaching or in retirement, you can't afford to lose your hard-earned wealth, the assets that you've built up over the years. And if you're someone who understands that Washington's fiscal debt is unsustainable, you actually need to be thinking about what comes next. And that's what we do here. We're taking a look at all the different elements that go into the fiscal part, but also how that maps out to what investments will actually be working going forward and which ones we need to be avoiding. And the passing of this irresponsible spending bill is really what's keeping the party going, because all the bulls are refusing to imagine a world that the credit card of free money gets taken away. They're refusing to look at what happens when the corporate earnings, when the borrowing costs rise, when we see foreign investors actually decide to pull money out and take their money home, you don't have to refuse to look at all this of what's going on. And in fact, you can't afford to. We need to be aware. And here is what I want you to do right now. First, I want you to go below and hit the subscribe button and ring the notification bell, because I'm going to be breaking down these liquidity trends and their impacts on your wealth regularly. And you don't want to miss these insights. Well, the second thing is, give this video a thumbs up. If this is really opening your eyes to something that you hadn't considered before, your engagement now can really help to reach more people who need to understand these concepts. And the third thing that I want you to do, I have more deep diving topics and specific strategies to navigate these environments. So I have a lot of videos here that I want you to check out, and I'm actually going to be putting some links here for the next videos for you to watch, particularly on how to position all of your hard-earned wealth with what's going on with this liquidity cycle. And finally, if you're sitting here thinking, I need someone who understands these macro trends and helping me protect my hard-earned wealth, then let's have a conversation. There is a link right below to schedule a meeting with my team. Remember, we are what we eat. That's the phrase, that's the mantra. And right now, our markets are going on artificial liquidity. And the question is whether the diet will eventually catch up with us, or whether we're going to be prepared when it does and what's next. So thank you for watching, and I'll see you in the next video right here, where we'll dive even deeper into specific positioning strategies for this environment. Till then, stay prepared, and remember, boring markets are profitable.